For the past 4 years, I've been watching the crypto debate go on, in the United States and everywhere else in the world. And I think a lot of times everybody's yelling and there's a lot of talking past each other and there's a lot of friction. And it seems to me that if our goal is to move forward in a constructive, progressive fashion, we'd benefit from a framework. So I put together a digital assets framework along with a set of principles, and I try to talk a bit about the ideology, what's the vision, and what's the opportunity. And I did it from the United States point of view because I think the United States really needs to lead in the digital assets arena. And if they do, I think it's quite likely that'll provide the air cover that will allow similar digital assets frameworks in the Middle East and Singapore and Japan and Europe, et cetera, and South America. So let's look at the different steps. I've got a taxonomy of different assets. We talk about how we legitimize these assets, and then what are the practices we need in order to how do we make this practical? And then the fourth section is on the vision. And the fifth section is really the opportunity for the United States.
So you have 6 definitions there. Most of them I think people have heard. Why don't you go through them? Commodity, security, currency, token, NFT, and ABT. I hadn't heard the last term in that acronym, the asset-backed token, but go ahead.
So there's a lot of types of digital assets. A digital commodity is an asset without an issuer, backed by digital power. A digital security is an asset with an issuer, and it's backed by a security. The third, a digital currency, it's an asset with an issuer, but it's backed by a fiat currency. A digital token would be a fungible asset with an issuer. Then you've got digital NFTs. It's a non-fungible asset with an issuer, offering digital utility. But the difference is you could have 10 million fungible tokens, and we get that. But if you have 100 different NFTs and they give you 100 distinct rights, then it's something different than the token. Now, the last one, digital ABT, asset-backed token, a digital asset with an issuer, but backed by a physical asset, backed by a bar of gold, backed by a barrel of oil. So that's the taxonomy. I could imagine other digital commodities. For example, China could take Bitcoin, fork Bitcoin, create China coin, and they could say, China coin is like Bitcoin, but it has special tax privileges in China, and it's only interesting to the Chinese people and 1.5 billion people. Maybe something as simple as you're allowed to mine China coin in China with Chinese power, and you're not allowed to mine Bitcoin. You would have, if everything else was the same, if there was no issuer. The real key is if you want to create a commodity, you need to create a network, disclaim beneficial ownership, and you can't point to anybody that has control of the destiny of the network or has some major beneficial ownership of it if you're going to achieve commodity status. Just MicroStrategy stock, if it was trading on Coinbase or Binance 24/7, 365, would be a digital security, right? Apple could be, AAPL could be a digital security. Now, I'm not saying it would only trade on Binance or Coinbase. It could trade on any, layer 2 or any tokenized network to speak of. But the point is, it would be one share, a token that represents a share of Microsoft stock or Apple stock. It's backed by the stock, but it's tokenized trading in the crypto world. If you had just equity in a private company, equity in $1 million restaurant, equity in a $10 million hotel, any kind of private equity, venture capital equity, any partnership interest, any claim on future cash flows. Maybe you own 1/100th share of my Airbnb business, right? Any of those look like small private securities, but if you had a digital assets framework, maybe you would publish the relevant disclosures, sign up to the relevant obligations, and you would put those on a digital exchange, and they trade 24/7, 365 globally.
To me, this is so obviously what should happen, because let's say you've got a hotel in, I don't know, Australia or, an inn in Brazil or something like that, they can put up a website, they can advertise for customers around the world. And in fact, they can process credit cards from around the world. You've got a motel in the Midwest, and they're already processing cards. They've already got a website that anybody in the world can access. What they can't do is capital formation, which is an obvious thing to do on chain. And of course, you need all kinds of procedures and so on for this, but that's solvable, right? Would you agree with that?
I do agree with that. I think that the existing capital markets, they require you to take 4 years and $40 million in order to create an equity which trades with a 4-letter ticker. And that's the 20th century way we did it. But what if we could do it in 4 hours for $40?
What we call maybe a stable coin, right? An asset with an issuer backed by fiat currency. So example, USDC, or if you put some other fiat currency on chain, the USDT might be that. But USDC would be the clear version of this, where you have an on-chain USDC, you have an off-chain USD in a bank account. And if you combine that with a digital security, you could, taking your chess example, raise USDC from people around the world. All those payments would be tracked on chain. And actually, you could potentially click a button and do your accounting. And if those people had whatever, profile information, you could automatically send them stock certificates. It'd be the equivalent of what Excel was.
What we're talking about is tokenizing a fiat currency, or tokenizing a checking account. So, I mean, the trick to this is there's no question everybody in the world wants digital dollars, and there's no question that if I live in China, or if I live in Europe and I have to pay in euros or CNY, I want tokenized local currency in those two frames of reference as well. Just like in Brazil, you might want tokenized real. So why do you want it? Well, you want it to be programmable. You want to move it at the speed of light. You want to vibrate it 1 million times a second. You want 8 billion AIs to be able to trade with each other 97,000 times an hour. It's like the utility is obvious. The challenge is, you need the nation state that issues the fiat currency to recognize it as legitimate. And then you need to overcome the privacy and the money transfer issues that, which pop up from place to place. I think we make huge progress simply by distinguishing the difference between digital currency, which is really Circle or Tether, versus digital commodities, which is Bitcoin, versus digital securities, which is your tokenized Apple share, versus a digital token, which might be any number of crypto tokens with an issuer that are, that have functionality in cyberspace or digital utility, but they're not securities, and they're not currencies, and they're not commodities. And the entire cryptocurrency industry has been saddled by this one name, currency. And all 4 of those things I just mentioned are sometimes referred to as a cryptocurrency, and the result is you just get massive pushback and fear and uncertainty and doubt. And we need to break them into 4 different categories so that people understand they're 4 different things for 4 different purposes.
So NFTs, I think, are pretty interesting. If a smart contract is on-chain code, NFTs are on-chain data. And I'm glad that you have a distinction between the fungible and non-fungible here, the digital token and digital NFT. Any thoughts on, because NFTs are on Bitcoin too as well?
Yeah, I think if you just characterize them as digital art, you're kind of underselling them. I think we got to think of them as a unique digital right. And yeah, I think about other types of rights, like maybe I'm Tom Brady and I post on some channel like on X, and I'm going to actually sell 10 superfan tokens, and numbers 1 through 10 actually get ranked and their responses underneath me. And if you always want to be the number 1 respondent, you buy NFT Brady 1. And if you want to be number 2, you're Brady 2. And if you're number 10, you're Brady 10. And if you owned Brady tokens 1 through 10, maybe that guarantees you for all of eternity, you'll always be one of the top 10 responses in that order. And there might be some super fan who's willing to pay $100,000 to make sure that their comment is always number 1, underneath Brady. It's like, it's a special right. Maybe it's a key to unlock something, maybe maybe it is a piece of art. If I said to you, this is a token that represents 1 acre out of 1 million acres in Kansas and they all look the same, right? That's a fungible token. But if I said this is 2 acres, in Palm Beach, on the beach, next to the country club, right? When you get to the point where it's a specific piece of real estate, and now we think about specific real estate in cyberspace. I can create real estate in cyberspace, right, with proximity and priority. So if you start to create things that have some kind of priority or proximity or provenance or some uniqueness, maybe there's something there that's interesting. And of course, the idea of the framework is, let's just give people the asset classes and create a Cambrian explosion of innovation, of which 99% probably won't be economically successful. But on the other hand, the 1% might be the Instagrams, the Metas, the Teslas of the world, and that'll be worth all of the other trouble.
Absolutely. And I think actually, one thing I would just say on that is I think of there being a spectrum of fungibility. For example, you could have a 1 of 1, like a digital Mona Lisa. You could have, right, you take your Miami example, you've got maybe 10 acres of land and each acre is its own NFT plot. So it's like, a 10 of 10. And then you could get all the way, for example, to, IP address space. As you may be aware, you've got 4 billion unique IPv4 addresses. And in theory, each of those could be tradable as an individual NFT.
A million thoughts spark up, and we probably don't want to go down this rabbit hole, but I just think about all the domains, like when you think about owning a domain, like I bought frank.com and emma.com and hope.com and angel.com.
Hope.com, great one. Yes.
Yeah, you're like, well, I don't know if they're actually physical assets or intellectual property assets, but you might very well attach an NFT to all sorts of interesting, unique things in cyberspace, and then they start to trade with the price, and they can be transferred at high speed, right? It's just a license.
ABT. So this is essentially something which is like gold or silver or oil. It's interesting. This is what it's useful to distinguish that from a digital commodity, because when you use the term digital commodity, you mean an intrinsically digital commodity, namely Bitcoin, and perhaps uniquely Bitcoin, at least at this point, as opposed to a digital ABT, which is often a commodity like gold or silver or oil that is traded on chain. And so it's a commodity, but it's basically traded on chain as opposed to being intrinsically digital. Would you agree with that?
Yeah, the distinction is a digital commodity is an asset without an issuer, and in order to create an asset with an issuer, you're going to have to back it with some kind of digital power, whereas a digital ABT is a tokenized physical commodity. And that means at the end of the day, you're going to have a warehouse with 100,000, little gold coins or 100,000 barrels of oil or 100,000 bushels of soybean. And that means there's going to be a custodian. There's going to be an issuer repping to this custodian getting audited. And now you're going to tokenize whatever that is. And you're going to tokenize it so that people can move it at the speed of light, so you can slice it, so you can fractionalize it, so you can finance it, so you get liquidity on it.